This is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Venk Shukla of Monta Vista Capital. Venk, thank you for joining us.
Well, thank you for having me on the show.
Can you tell us a little bit about how you got into early stage investing?
I'm an accidental VC. I used to be a serial entrepreneur, and my last startup turned out to be what we in Silicon Valley call a valuable learning opportunity. And I had gotten into this without doing enough diligence on my part. A VC that I respected, who had put some money in, told me that this is a great technology and stuff, and I should do this. So I joined the company, raised bigger VC money, and then I realized along the way that this is not a company, this is a science experiment. So my learning from that experience was that next time I'm not going to jump into something, take some time off, and I'd given myself 18 months. That I'll just stay home for 18 months, and then we'll decide something to do. I got bored in those 18 months. And so I started something that I always wanted to do, which is to do angel investing in an organized way. So I put together a group of about 80 angel investors under the banner of TIE in Silicon Valley. And we started doing angel investing. And I was very disciplined about my diligence process and all of those things. And the group ended up doing about 25 investments. I wrote only 5 checks, but it turned out those 5 companies were the most successful ones out of the 25 that the group invested in. So not only was I making good decisions, but it turned out that I really, really liked this. I liked the idea of meeting entrepreneurs who are very optimistic, and everyone believed that he or she is going to change the world. And it was very energizing to interact with that profile of people. And the second thing is that I tend to be intellectually curious. I like to know a little bit about everything. And the benefit that I saw was that everyone who walked through those doors, they were expert in something, and they would educate you. So I said to myself, wow, you're meeting the most optimistic people in the world. They're experts in something, they educate you. And in the process, you see, you're making money. I said, what is not to like about this? So I went ahead and I decided that I won't be an entrepreneur anymore. I would be a VC. So I went around to my friends and raised some money and started the Monta Vista Capital. That's how it started.
So when you were investing with the TIE angels into these startups, what was your investment thesis or criteria that you invested in? If you had 5 of the best deals, how did you do that?
I had 2 rules of thumb. One rule of thumb was that investing is a team sport. So I would not touch a deal unless there were at least 3-4 other people that I respected also showed interest in that deal. And in the process of discussing and arguing about pros and cons, I thought this made me a better investor. So that was one rule of thumb. The second rule of thumb is that I would not invest unless I got a deep domain expert to do diligence on that deal. And I had a big Rolodex, so I would lean on people to do different domain experts to do diligence for me. And if they did the diligence and gave their thumbs up, I'll ask them if they are going to invest. And if they did not invest, I will not invest. And that's why, that simple rule of thumb helped me save a lot of money. And my hit rate was 100% of the companies that I invested in.
And when the domain knowledge person was looking at it, were they looking at it from a technical point of view or a business point of view or marketing point of view or all of the above? What was their criteria for turning thumbs up and investing?
I would expect them to do diligence from a technology standpoint and from that product being useful in that market. As far as the market sizing is concerned, that we will do. Whether or not there's a need for that product in that market that's something that I rely on a domain expert to tell me. And so given that, I said, so I took those learnings to my fund also. I started my first fund in 2014. We have made about 20 investments, and the fund has done extremely well following these simple rules of thumbs.
And so you just know the domain experts from your network. What if you get a deal that you don't have a domain expert? How do you handle that, or do you just not consider it?
Well, I mean, there are all kinds of deals that come to you, and there are certain domains that I really don't have much of a relationship connections in. So anything you do with, for instance, agriculture technology or water technology, I just really don't have the domain expertise, or energy. I just don't have people in my network to do that. So I stay away from those things.
So you just don't do deals that you can't find good, deep domain technology information about.
Yeah.
Okay. And so is the Thai Angel group still going, or did they
Yeah.
move on
No,
to other
it's still
things?
going.
Okay.
It's still going. I'm not as active after I started my fund. So I was active with them from 2011 to 2014. I started my fund in 2014. And since then, I've not been as active in that group.
I see. Are you still active with the Thai Silicon Valley, and how are things going with that group?
It was going great. I'm no longer the president, but it has long heritage and strong traditions. So it continues to do well.
Okay. And the Monta Vista Capital group, what is the areas you focus on? Is it anything with tech, healthcare, or otherwise, or do you have certain areas that you focus on in the Monta Vista group?
Not healthcare, but in general, we look for deep technology differentiation. We look for business to business. In general, we don't do business to consumer kind of deals. We do business to business. We look for founders to see who have a lot of domain expertise and some unique insight about that domain.
So one thing we used to talk a lot about in business circles was competitive advantage. And one thing I've noticed over the last couple of years is I hear very little about competitive advantage anymore. And what's replaced it is, do you have recurring revenue? And if you have recurring revenue and sticky revenue, well, then you're going to probably have a successful business. That's good enough. Let's go forward. What's your take on competitive advantage in today's world? Is it still being practiced and viewed as a critical factor, or has it become sort of a secondary thing?
The stage that I invest in, there's hardly any revenue. So revenue at that point is a dream or a PowerPoint projection. So then, and typically companies that are starting out, they are starting out trying to solve a new problem. So it's very hard to know who the competition is. And the competition is also somewhere there. There must be at least 2 or 3 other companies somewhere trying to solve the same problem that nobody knows about them. And they become obvious only they have the products and they start going to the market and starts running into each other. Then you know that this thing is emerging. But at early stage, I think it's not the competition. It's what problem are you solving today that is not being solved by the incumbents.
So the uniqueness you're looking for is they found a new niche or a new angle into the problem that they're solving that no one else is solving or no one directly is solving.
Exactly.
At the very, very early stage when it's nascent, how do you handle pipeline competition? There's somebody else trying to solve it, but they're really not up on the radar like the incumbents yet. So it's hard to know that they're out there because new sectors like AI, data analytics, there's so many things going on that are not yet on the marketplace, but somebody out there is working on it. How do you handle that?
We don't. I think it's very hard to know. So I think you have to go by your assessment of the team, your assessment to see of the market size, and your assessment to see of ability of this team to out execute the future competitors.
So it seems like this model has served you well. Are you increasing your fund?
Yeah. So I think first fund was $10 million. This fund would be at least twice as big. And but we want to continue to stay in the space that we are in, which is early stage. This is the hardest one to invest in because sometimes there's no product and there is definitely no revenue. So others find this space very, very risky. And I find this space, extremely good for me. My failure rate of companies in my portfolio is, people say early stage investing the failure rate is about 30 to 40%. Failure rate of companies in my portfolio is less than 10%.
And what were the failures due to in your portfolio?
In one case, you see, the company was not local. And at early stage, if the company is far away on the other side of the country, it becomes difficult, you see, to interact and manage with them.
So the ones that failed weren't local and therefore they couldn't get support or oversight. Was that the main reason?
Yeah, primarily.
Okay.
I mean, I wouldn't say that was the main reason, but I think the main reason was that the spent a lot more money on other things before they had the main product, before they had taken out all the risk associated with technology.
So a lack of focus on getting the product market fit wasn't all the way there?
Yeah. I think that the technology, I think before they started spending money on all the other things, they didn't focus enough on taking out the technology risk.
Very good. Well, very good. Well, in the last minute or two that we have here, what else should we talk about that we haven't?
I think one advice to entrepreneurs is that, that when they are pitching, you see, to sophisticated investors, they should stay away from using buzzwords. Fourth industrial revolution, artificial intelligence, and this and that. I think people have heard enough of this. They should focus on what problem they are solving and why they are uniquely qualified to solve that problem and why that problem is big.
Well, certainly not using buzzwords would make you stand out from the crowd because just about everybody does it these days. And then as an investor, you look back over the pitches from the last month and they kind of blur together sometimes because they're all solving the same problem in the same way. So in your way, they get more uniqueness and differentiation just in the pitch alone.
Yeah.
How best for the audience to get back in touch with you?
Just send me an email, and email is on our, basically they go to our website, Monta Vista Capital website. There's a form there, and they just write 1 line, 2 lines, whatever, and drop it in the box. It will come to me.
Great. Appreciate you taking time to talk. We'll put that information in the show notes so people can get back in touch with you, as well as the Monta Vista Capital website. So appreciate you taking time to talk today and look forward to having you back on a future show to talk more about these topics. But thank you so much.
Thanks, Issy. I enjoyed this conversation.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.